Right on. Thank you, Reed. Thank you for having me, and thanks for everyone stopping by today. Right off the bat, I'm going to let you know that I'm in sunny Yucatan, Mexico for the holiday season, where the internet's been pretty strong for the last couple of weeks since I've been here, so hopefully that will be the case in the next 45 minutes. So let's keep our fingers crossed. So welcome to my NoBSForexTrading.com presentation today. And before we get into the meat of the presentation, I have to put up that inevitable disclaimer, which pretty much says be responsible for your own actions. And while it's up here, I'm going to tell you a little bit more about myself. I was pretty much born in a trading family. My mentor, teacher, and stepfather is Robert Miner of Dynamic Traders Group. And when I graduated from UC San Diego back in the day, I got a degree in biochemistry, cell biology, and started working in a lab. And there's a lot of downtime in a lab. So what did I do? I started trading stocks and ETFs using the methodology that Robert teaches. And I started doing relatively well. The biochem company that I worked for went down the tubes and I got laid off. Robert approached me and says, you want a lifestyle with more freedom and make more money? And what did I say? No brainer. Let's go for it. So he then took me under his wing, and I got even better at trading, almost like learning how to play basketball by Michael Jordan in a sense. And things got good. He had a futures advisory report at the time because he's an avid futures trader, and he wanted to start a stock and ETF advisory report where we give our clients just pretty much the analysis and trade strategies that we're using in our own trading. And I had a background of technical writing, having a background in science, so I said, let's do this. And that started my over 10-year career as the chief trade strategist for Dynamic Traders Group. Then, hold on here, I just want to make sure everything's running okay. We're all good. And then I actively started trading the Forex markets. I fell in love with the 24-hour high-volume characteristics of the Forex market, and I started doing really well once again. So we started at the DT, or Dynamic Trader Forex Report. Since then, I've branched off from Dynamic Traders. It just kind of made sense because Bob is mainly a futures trader, Robert's mainly a futures trader, and I'm mainly a Forex trader. And so came about NoBSForexTrading.com. And I'll talk more about that later. Let's get into the meat of what the webinar is about. There we go. So what I'm pretty much going to do today is just talk the basics of my trade strategies, or really my favorite trade strategy. The reason I say trade strategies is because there's a lot of variations to this trade strategy. And what I'm going to do here is I'm going to just go over what this small list is here about the aspects of my trade strategy. It's going to be a lot of information, but then we will get into some examples where everything will become clearer. So just give me a few minutes to talk about this, and then everything will be a little bit clearer, and I'll visually show you what I'm talking about. So what I basically try to do is get into a trade at or near the end of a correction. A correction or counter trend usually trades in the direction opposite of a trend. This might be pretty basic to you, but if it's a bear correction, I try to get into a long position at or near the end of that bear correction to get into a position in the direction of the higher degree time frame trend. I'm pretty much a position or swing trader, I guess you can say. I tend to mostly enter my trades in a 60-minute time frame, trying to trade in the direction of the higher degree time frame 240-minute chart. If you're a shorter term trader, maybe you like to enter in a 5-minute chart, the higher degree time frame would be 15 minutes. If you're a longer term trader, maybe you like to enter in the 240 higher degree time frames daily, high degree time frame weekly. You get the idea. So for me personally, I look first at the 240-minute chart and look for characteristics of a trend, which we'll talk more in detail in a few moments. And then I look for a potential counter trend, and then I use an oscillator to determine the net trend direction over the next several trading hours or whatnot of that time frame, which would be the 240-minute time frame, and then I look to enter a trade in the lower degree time frame 60-minute chart. The oscillator that I personally use is called the DT oscillator. It's a proprietary oscillator to the Dynamic Trader software, but it's basically a stochastic RSI. Other couple of good oscillators you could use. You can use any oscillator of your choosing, but the two other favorites of mine are the slow stochastic and the stochastic RSI, which I just talked about. Bottom line is you do not need the DT oscillator or the Dynamic Trader software to benefit from my analysis or trade strategies, but I use an oscillator to help determine the trade direction of the low degree time frame. And so once I've determined that, I go down to the low degree time frame, and like I said, I try to enter at or near the end of a correction. If it's a bearish correction, I try to enter a bull position. If it's a bullish correction, I try to enter a bear position. And I also use an oscillator in this time frame to help to determine the end of the correction. Another important aspect of my trade strategies is trading more than one unit. The reason I trade more than one unit is if you do trade more than one unit, even if your analysis is incorrect, and I'll tell you right now, there'll be a lot of times your analysis is incorrect, you can still get into a profitable position, or the position will end up being profitable. It might just be a small profit, but if you trade more than one unit, even if your analysis is incorrect, you can result in a profitable position. Another very important aspect of my trade strategies is you must always have a 100% objective entry and stop loss placement strategy. In other words, when all the criteria of your trade strategy come together and it's looking like you should get into a trade, you should know the entry price of that trade and the stop loss placement price of that trade before you enter the trade. When you do that, you will then know your capital exposure. You will know the max loss you can lose in that trade. You will know the pip value between or the number of pips between the entry and the stop loss placement. Calculate the value in a monetary sense, in dollars, and then you can apply that to your money management plan. I have a couple of equations. I just spit the entry and entry price and potential exit price, and it tells me how many lots I can use per unit. Money management also is very important. I don't have enough time to get into money management in today's webinar, but it is also a very important aspect for my trade strategy, and it should be a very important aspect in your trade strategy, because trading is a business, and every business should have a money management plan. It's also a good idea to have an objective exit strategy for your first unit. It's not as important as having a 100% objective entry and stop loss placement strategy, but it is important to have an objective exit strategy for one unit where if it hits that price, you consider an exit strategy for at least the first unit so you can secure some profit in the event that the rest of the trade does not go your way. So with that said, this is a lot of information here right now. With that said, let's go into some examples, and I'll explain more visually of everything I just talked about. Let me see how this works here. There we go. Everyone now should be looking at a 240-minute chart of the New Zealand dollar, US dollar cross. I'm just going to get a quick drink of water here. And okay, so this is a 240-minute New Zealand dollar, US dollar cross chart through current data. We got a rally from the November 7th low down to the up to the November 17th high with a non-overlapping wave pattern compared to the overlapping wave pattern characteristic of a correction. So first of all, you're going to see numbers up there, and yes, my trade strategies and analysis are based on the Elliott wave theory, but I like to say it's loosely based on the Elliott wave theory, meaning unless there's obvious places to put wave counts, I don't worry about wave counts. What I put most emphasis on is the characteristics of trends and the characteristics of counter trends or Another word for counter trends is corrections. So this November 7th to November 17th rally did unfold in a pretty much textbook 5-wave rally, but the most important thing is it has a non-overlapping wave pattern characteristic of a trend. Then the decline off the November 17th high has an overlapping sideways to down pattern characteristic of a bearish correction. Trends usually unfold in the direction of a higher degree trend. The counter trend usually unfolds in the opposite direction of the higher degree or main trend. So this is pretty basic and logical here. If you get into a trade at or near the end of the correction, so if it's a bearish correction like in this example, you look to get into a bull position, that should put you in a position in the direction of the higher degree trend. And if this in fact is a bearish correction, then once the correction is complete, if not already complete as of today's low, we should have a rally eventually to above the November 17th high. Okay, all basic logical stuff here. Now let's look at the oscillator. The bottom oscillator here, this is the DT oscillator I use, which is basically a stochastic RSI. But in all my charts, or in most of my charts and my analysis, I also put the slow stochastic, which you can find in pretty much any trading software, any trading platform out there. So if you can see that the swing highs and lows of this market correlate relatively well, not perfect, but relatively well with the bearish and bullish reversals of these oscillators. So let me put up some crosshairs up, and you can see right here this bullish reversal correlates relatively well with this swing low. A bullish reversal is when the fast line of the oscillator crosses above the slow line. This bearish reversal here coincided very well with this swing high. A bearish reversal of the oscillator is when the fast line crosses below the slow line. Here with this swing low, we had a couple of bullish reversals. However, when both the fast line and the slow line exited the oversold zone is the bottom 25% of the oscillator range, shown when the bottom line of the oscillator. When both the fast line and the slow line exited this the oversold zone, then the market started to rally. Then we had a bearish reversal here within 2 bars of the swing high, 2 or 3 bars. If this pattern continues between the oscillator bearish and bullish reversals, then the next bullish reversal should coincide with a major swing low, or a swing low lasting at least a couple of days, it looks like. And then the next bearish reversal should coincide with the next swing high, with that last probably at least a day or two. So this is also very easy, basic, and logical. So all you do with any oscillator you're using is tweak the settings until the bearish and bullish reversals of the oscillator you're using correlate relatively well with the swing highs and lows of the market you're looking at. Basic, logical, easy. Okay, so this is the 240-minute chart that we're looking at right now. This is the high degree time frame for my personal trading. So I would look to enter in the lower degree time frame. All criteria in the 240-minute high degree time frame chart have all come together for me to look for a short position. I got a rally that has trends of impulsive characteristics. Let me repeat that. I have a rally with impulsive characteristics, or characteristics of a trend, followed by a decline with characteristics of a correction. Also, today's low so far is just 1 pip above a strong I'm backwards today, a strong support level that everyone knows about, the 78.6% retracement support level of the November the 7th to 17th rally. And I have a bullish 240-minute momentum. So as of right now, I just don't go down to the 60-minute chart and jump into a long position. I can now look to enter a trade in the 60-minute chart. But let's go down to this. This is all for example's sake right now. Let's go down to the 60-minute chart, and I want to show you a little bit earlier today, and then we'll talk about present time, okay? So earlier today, there was actually a nice trade setup, okay? The 240-minute, the position of the New Zealand dollar, US dollar cross was not in a very different position as of right now. It's looking more like this. The oscillator was bear oversold. Long positions still could be considered in the low degree time frame 60-minute chart. I went down to the 60-minute chart, and at this time the 60-minute oscillator was bullish. This is actually from this December 1st minor swing high, the 60-minute chart. And I'm looking at an oscillator setting that's okay, not perfect, correlates pretty good with the swing highs and lows of the small swing highs and lows of this decline off the December 1st high. The bottom line is we have the oscillator bullish right now, okay? There's many different kind of trade entry setups depending on what kind of trader you are. There's a trailing one-bar high trade setup, which is more of an advanced trade setup. There's taking out a minor swing high, which is more of a beginner trade setup, and we'll talk more about that today. So everything's all set up for a long trade setup. Minor swing high as of right now in this market, in this time frame, is the 0.7761 minor swing high. So if we get a rally above this, that's a long trade setup, as long as the 60-minute and 240-minute oscillators are still bear oversold or bullish when the bar before this is exceeded. And we have, so this is our projected entry price, and this is our projected stop loss price. So now we have a 100% objective trade entry strategy and a 100% objective stop loss placement strategy, a 100% objective potential entry price, and a 100% objective stop loss placement price if the long trade is triggered. Now what you can do is, you know your capital exposure here, you can calculate this distance in pips, and then calculate the monetary value of that, plug it into your money management equations, and it should spit out how many lots you may trade per unit. Okay, and like I said, trade at least 2 units. If you're a beginner trader, I wouldn't trade more than 2 units, but if you're more advanced, you can trade as many units as you wish, as long as it stays within the rules of your money management plan. So if a long trade is triggered, we can talk about a price target to at least bring your stop to break even, or to consider an exit strategy for at least the first unit of your long trade if a long trade is triggered. So a good place I like to look at is at the 50% to 61.8% retracement resistance area of the last swing decline of the potential corrective decline, in this case, off the November 17th high. Quick drink of water here. The reason I use this 50% to 61.8% retracement resistance area, just in the event that a long trade is triggered and a rally off a low lasting several trading hours is only corrective. It's not actually the anticipated completion of this corrective decline off the November 17th high. So if a long trade is triggered and the 50% retracement is reached, I would consider exit strategies for at least 1 unit of the long position. Once again, there's many different kinds of exit strategies, and obviously we don't have enough time in this webinar to go through them, but that's a good place to consider an exit strategy for at least part of the long unit. So let's see what happens. This was earlier today. Now we have the 60-minute bull over bought. The criteria for a long trade setup has now been canceled. It has to be bear oversold or bullish in both high degree time frame and low degree time frame to consider a long position. So this is out of the water, and what do? We wait for the next long position, our long trade setup. And this is actually kind of a shame because it did take out that minor swing high. and it did reach that 50% retracement. However, the important thing to get out of this is even though this trade was not triggered, the important part is to stick with your trade strategy no matter what, because while our trade strategy kept us out of this long position, in the long run, your trade strategy will keep you out of bad trade setups. So it doesn't always work out. The point is to get ready for the next trade setup. So now we're looking at current day's data. This stochastic RS, or slow stochastic, is not really correlating relatively well again, so you'd want to tweak it so it does, but we're not going to do that right now just because of timing. This is current day's data, or current data right now in the 240-minute chart, so everything's up for a potential long trade setup. Let me see what's going on over here. Let me see what this low is right here. So we have the same low. You can use this right here as a minor swing high. If this is triggered, you have your long trade setup. You have your potential entry price, potential stop loss price, as long as a new low is not made. And there's a couple of potential places that you can consider exit strategies, but you could consider exit strategies here at this 50% retreat. That's close to the market, but you will get some quick profit, and then you'd have another unit in the market in the event that this high is exceeded and potentially the corrective low is still complete to today's low, potential rally to above the November 17th high. So another good long trade as of right now in the New Zealand dollar US dollar cross. So this example here explains pretty much everything I talked about in the PowerPoint slide, but let's go ahead and check out another example. I got to turn a light on here really quick. It just got dark where I'm at. There we go. Okay, I am back. Another drink of water, and we'll check out the Canadian US dollar cross here. Okay, this is also a 40-minute chart, my high degree time frame. And check out this November 21st low. We got the October 29th to November 5th rally with a, it doesn't have Elliott wave counts, not really one to put up there. The bottom line is the characteristics of this rally, characteristic of a trend followed by a decline with sideways overlapping wave patterns down to, again, check it out, the 78-point retracement of the potential trend rally. It was just a few pips below that 78 points retracement. This is to current data. We've had a rally to just slight low high as of the December 1st high, but it did not exceed the November 5th high, confirming the corrective low. Nonetheless, very likely this November 1st low is a corrective low. I also want to show you here in this example is, look at this little 5 rally here, okay? And then we have a little ABC corrective decline down to this November 26th. Let's go and put this right here, or actually, let's go down the 60-minute chart. Let's go all the way over here. We already know what happens, but I just want to show you that these are not all after the fact examples. They're after the fact, but I put these in many of my advisory reports. So this is November 26th, okay? Let's go to my membership web here. This is a membership page. If you subscribe to either my No BS Forex Net Trend video, let me show you here. It's a 100% video report that covers 8 top Forex markets. I do it Wednesdays and Saturdays and give a 5 to 10 minute video of the Euro US dollar cross, British pound, Australian dollar, yen, Canadian dollar, Swiss franc, New Zealand dollar, and British pound cross. And what I do is I give a 5 to 10 minute long video each of these markets talking about the probable net trend direction of the weekly, daily 40 and 60-minute charts. I talk about pattern, support, resistance, and potential trade sets if there are any at that time in each of the time frames. So it comes out Wednesdays and Saturdays. And then I have my unbiased Forex workshop. That's a 9-hour workshop that I also have. Talks a lot about this trade strategy among many others. And then I have my daily report. It comes out Monday through Thursday and Saturdays. Okay, covering the same 8 markets just showed you in the net trend video page. So let's go down to, what was this? The November 26th low for the US dollar, Canadian dollar cross. I always have at least 2 weeks of daily reports on this page. So here's 6 right here. Bam. Let's go down to the US dollar, Canadian dollar cross. Each daily report has the 240 and 60-minute charts of each of the 8 markets. Like I said, this is just the every day for my trade strategies I use on a daily basis. I also have a daily chart market and weekly charts for each market. Here's the US dollar cross 240-minute chart, which was actually in this November 26th report. November 21st, potential corrective low I talked about. And let's go over here, chart, and look at this 5-wave rally. Textbook Elliott 5-wave rally. Like Elliott, it has characteristics of a trend wave which shifted in the time frame trend. We have a potential ABC corrective decline, which is a correction, 3-wave correction. Okay, I stated in this report, long positions consider. One thing that wasn't right for the trade setup was we only had the fast line in the open. So I stated in the 60-minute trade strategy that long positions may be considered 40-minute oscillators bear over sold or bullish, as long as the 60-minute oscillator is not bull over bought or bearish, because that would cancel our trade setup, for a potential rally to the 50% the decline off today's high, which would be the November 26th high at the time, if not to above the November 25th high. And if we go back to this, and what happened here? I lost my, there it is. I can just take away a few charts and a few bars, and if you can see, this is exactly what happened. We had a rally to at least the 50% retracement of the decline off that November 26th high, and then we had a continued rally to above the November 25th high, confirming the corrective low much further. Yes, I know maybe you didn't take advantage, you didn't profit in this whole rally because exit strategies, there's different kinds of exit strategies, but I just wanted to show you how powerful this trade setup is. And let's go ahead and add bars for current data right now, okay? And once again, this isn't correlating relatively well, but the DT oscillator is. So look at what we have here. This is current data. We have a rally from the December 1st low to the December 2nd high that has more impulsive than corrective characteristics. Did I say that right? December 1st to December 2nd high. Then we have a decline off the December 2nd high with an overlapping sideways to down pattern characteristic of a correction. And check this out. Our good old buddy, the 78.6% retracement. Look at that thing. All over the place. And today's low is slightly above the 78.6% retracement. Let's go to the 240-minute chart, current data. The 240-minute oscillator correlates relatively well with the swing highs and lows of this market, and it's bullish. So what do you think? Long trade setup, I'd say very likely a long trade setup. You could above this high at the least, as long as when this high is exceeded. Here's the minor swing low right now. Put a sell stop below that. You can put a sell stop where you want. I mean, this is my trade strategies. Here's one thing about trade setups with lower capital exposure. Trade setups with lower capital exposure, which everyone's looking for, less risk. it's a less risk dollar amount, but it could be higher risk as far as probability. The further away you put your stop, the more probable, just because of the movement of the markets, the further away you put your stop, it has higher capital exposure. However, it usually has higher probability. So it's a give and take situation, and this all it all is about what type of trader you are. Okay, so a rally above today's high is a long trade setup as long as both the 60-minute and 240-minute DT oscillators are not bull overbought or bearish when this happens for a probable rally to at least above December 2nd high. Okay. And if, in fact, this November 21st low is a corrective low, very likely to above the November 5th high. So this is another potential long trade setup. The only thing that kind of goes, this rally is hard to say right here if this is corrective or impulsive. So it's something you might want to think about. So you're probably saying right now, Jamie, this is amazing. I've never seen anything like this, right? It always works out. Actually, that's not always the case. Let's take a look at this. This is a Euro-US dollar cross, okay? And this is December 1st low. So let's go to the December 1st report. There we go. And let's go to, here's the 240-minute chart. And the 240-minute oscillator correlates really well with the longer-term swing highs here. And if we go down to this 60-minute chart, we have a rally from the November. This is exactly where we are here in the chart, just to not get you confused here. This is actually in the report. So you're looking at this and you're saying, wow, this November 26th high looks like the completion of a nice trend wave up, followed by a decline with overlapping wave patterns right below the 50% to 61.8% retracement support zone of the November 23rd to November 26th rally. This is the typical price target for a corrective low or a wave 2 or B low. Nice rally up. Higher degree time frame oscillator is bullish. Man, this is the wave 2 or B low for sure, no matter what. Sell the farm, go long, put that deposit on that beach house. But trades don't, or markets don't trade ideally all the time. And let's look to see what happened here. Not only was this not a corrective low, we had a decline to below the November 23rd low, avoiding this whole decline off the November 26th high as corrective. So like I said, markets don't unfold ideally all the time, but that's why we use stop losses, okay? And when you have a 100% objective entry strategy and a 100% objective stop loss strategy, then you'll know your calculated loss. Not all trades are going to be winners, but look at this. Depending on what trade setup you use, this rally reached the 50% retracement of all kinds of swings. So depending on what trade setup you use, and if you're using a at least a 2-unit trade setup, this trade might have been a break even or even a tiny profit and not a loss, depending on what trade setup you use. And trailing 1-bar high trade setup, I'm not sure a minor swing high trade setup that we were talking about would have done that, but that's another example of why you should trade more than 1 unit. So let's check out the Japanese yen cross here really quick. Another example. Unfortunately, I got to take these bars off just because I'm looking at live data right now. This is the December 1st low, and this is the same report we were looking at. December 1st, Japanese yen cross. Here is the 240-minute chart I actually had in the December 1st daily report. This November 27th low was a confirmed ABC corrective low, but that's in a different report. We had a rally above the November 20th high confirming the corrective low, and now we have this oscillator, 240-minute oscillator, bear oversold. Long positions may be considered in the low degree time frame 60-minute chart. Let's go down to the 60-minute chart to see what's happening. This is in the December 1st report. This is the same that I have right now in the chart right now. I think it's to the bar. And here we are. I state in the chart that the decline off the December 1st high has more corrective than impulsive characteristics. And I read this earlier, a little typo here, and left out a word. But today's low is slightly below. That'd be the December 1st low at the time. It's slightly below the 50%, the 61.8% retracement zone of the November 27th to December 1st rally. We got the 60-minute oscillator bullish. This little table right here I have in all charts, which shows the momentum or oscillator position of weekly, daily, 240, and 60-minute time frames. This shows the daily was also bullish. So you got oscillator positions of 3 time frames, bear oversold or bullish. Strong momentum signal that the net trend should be sideways to up for several trading hours, if not days. So this is a pretty good long trade setup. Right here in the summary, I state with the 240-minute DT oscillator bear oversold and the 60-minute DT oscillator bullish, very likely a corrective low is near completion, if not already complete, at today's low. A rally above the December 1st high should follow a corrective low. Okay, bear trade setup you don't have to look at because you can't look at bear positions right now with the 240-minute oscillator position. I hope I'm not making you dizzy moving the window up and down. And here's what the bull strategy was at the time. With the 240-minute oscillator bear oversold and a 60-minute oscillator bull, long positions may be considered. And I'm saying considered right now. Maybe you want to take out a minor swing low, trailing 1 bar high. Sometimes when everything's lined up, I just jump in. I know when I'm going to get in within a few pips because of the high volume of the Forex markets, and I'll know where to place my stop, which would be below this December 1st low. Long positions may be considered for a potential rally to the 50% retracement of the decline off today's high, the December 1st high, if not to above the December 1st high. Let's go back to the Japanese yen 60-minute chart here, and this is to the bar it was in the report that day. So if you jumped into a long position right there, everything was set up, or you can wait for a trade to take out the swing high. It all depends on your specific trade strategy, and which I should mention you should have written down before you even look at the markets on a piece of paper right next to you. Have your rules, all kinds of rules that you need, and stick to it. All right, that's the main thing you need to do is stick to it. So anyway, long trade setup, long trade triggered. You got your 50% retracement of the decline off yesterday, off December 1st high, as I mentioned in that trade strategy. So that's a good place. You can consider exit strategies for the first unit. I know it's not that far from the market, but you will conserve some profit if you do that. And then you could even, if this minor swing high is taken out right here, you can even adjust your stop to this. And then for a potential rally to above the December 1st high, which exactly what happened. That was a really nice short trade setup, very low capital exposure, and it worked out. So these trade setups that I'm looking at are not things I'm making up right now. These are things that I actually put in my reports on a daily basis. And like I showed you in the Euro-US dollar cross, yes, they don't always turn up the way you wanted them to, but if you use a stop loss like every trader should do, you shouldn't have any kind of devastating losses, and you'll be ready for the next long trade setup or short trade setup, whatever comes along. I'm not quite sure why all these examples are long trade examples. I don't have a short trade example. So I want to bring one more thing up. I'm not sure how much time I have left. I probably should open this thing up. 5-minute warning. I'm not sure how long ago that was. Okay, let me just show you one more example right now. Just really quickly. This is a quick example, and then I'll British pound, Japanese yen cross. This is a current. This is as of right now, or as of I saw a few moments ago before the. Here we go. First, I want to show this is a raging market. This is a weekly chart we're looking at. Just a raging bull trend here in the British pound, Japanese yen cross. Daily, even off this October 15th low, raging bull trend. 240-minute chart keeps on rising. Right now, currently, we have the 240-minute oscillator bullish go down to the 60-minute chart. Now we have a bullish reversal with a decline, even though no matter what this is doing, this is a corrective decline, okay, in a lower degree time frame in a bull market that's just out of control bullish in 4 time frames. So whenever you can get into a long position or a short position in a raging bear trend, but a long position in a market in a raging bull trend, this is my favorite trade setup right here. This is obviously has a sideways to down pattern, and where you take this trade setup is kind of up in the air. There's not really a minor swing high here, but we have a bunch of inside bars right here to this bar right here. So I'd go long above this as long as the 60-minute and 240-minute DT oscillators are not bull over bought or bearish for a rally to above here, which is close to the entry, but this bull trend is so strong it might go up for several more trading days. So this is a great long trade
Jamie,
setup with not much to it.
I don't mean to interrupt. You got a little bit less. You have a little bit less than 4 minutes left.
Okay, so I hope you found these examples helpful, useful, and see the power of this trade strategy. Let me go back here and just let you know about what I can offer you. And it's pretty simple here. Through the end of the year, if you're a new subscriber, I'm going to offer you a very large discount for both my daily report and my net trend reports, both together for only $19.95 for the first month. It's regularly $69. That's more than $50 off, over a 70% discount. If you have any questions whatsoever, I probably don't have time right now, why don't you email it to me at jamie@nobsforextrading.com. Let me just show you this. I probably have just enough time to do this right here. Just take this link, throw it in here really quick. Since I don't have much time, I'm just going to show you this. And this page explains in extent what you get for only $19.95. Information, a lot of videos, a lot of daily reports. It's explained here. Download my free ebook. It's a real short ebook, but it's very precious. It's it gives you a bunch of questions, and you can honestly ask them to see what type of trader you are. Then you will know what type of trade setups to take. So take advantage of least of the free ebook. And hey, it was I'm happy I got this opportunity to talk to you the last 45 minutes. Ran out of time here, but thanks for stopping by. Reed, back to you.